Welcome, readers. Today, we'll talk about an important topic: how businesses can protect themselves when selling on credit. Many companies sell goods or services and allow their customers to pay later. This can help build good business relationships, but it also brings risks. What if the customer cannot or will not pay? These risks are called credit risks, and managing them well is key to running a healthy business. Even if a business checks a customer's credit history and sets clear payment terms, there is no guarantee of payment. Things can change quickly in business. A customer who seemed reliable last month might face sudden problems like bankruptcy or cash flow issues. Sometimes outside events like economic downturns, political troubles, or natural disasters can affect a customer's ability to pay. This is why smart businesses always look for ways to reduce credit risk, not just rely on good credit checks. They use special tools to protect themselves from the chance of non-payment. The three main tools are trade guarantees, credit insurance, and letters of credit. In this essay, we'll explain each tool simply and help you see when to use them. By the end, you'll have a clear understanding of how businesses manage credit risk. You'll also get tips on choosing the right tool for your situation, so you can trade with peace of mind. Let's start with trade guarantees. A trade guarantee is a promise from a third party to pay if your customer does not. Usually, a bank or insurance company acts as the guarantor. If your customer cannot pay their debt, you ask the guarantor to pay instead. This can give you real peace of mind. There are different types of guarantees. The most common is the on-demand guarantee. This means that if your customer fails to pay, you can demand payment from the guarantor right away. No long court battles needed. The process is often simple and quick, which makes it attractive for many businesses. Trade guarantees can be low cost compared to other options. They also show that your customer is serious, because they had to arrange the guarantee. But the real value of a guarantee depends on the strength of the guarantor. If the bank or insurance company is weak or slow to pay, you might still face problems. Trade guarantees work best for medium-sized deals with customers you know, but where you want extra safety. They are especially useful in construction, export contracts, or when dealing with new buyers. Credit insurance is another tool businesses use. With credit insurance, you pay a premium to an insurance company. In return, the insurer will cover most of your losses if a customer does not pay. This is a bit like car insurance, but for your sales invoices instead. Most credit insurance policies cover 80 to 90% of the invoice value. This means if you sell 10,000 pounds of goods and your customer does not pay, the insurer might pay you 8,000 to 9,000. The rest is your loss, which keeps you careful about who you trade with. Insurance companies like Euler Hermes, Atradius, and Coface are big names in this field. Credit insurance does more than just pay out after a loss. It often helps you check customer credit before you sell, and may cover political risks, like wars or new trade bans. Some banks are more willing to lend you money if your sales are covered by credit insurance, because it makes your cash flow safer. However, there are downsides. Credit insurance costs money, and sometimes policies exclude certain risks, or limit how much they'll pay out. You need to read the policy carefully to know what is and isn't covered. It is best for companies with lots of customers or those doing business in risky markets. Now let's look at letters of credit, often called LCs. These are very common in global trade. A letter of credit is a promise from your buyer's bank to pay you, as long as you provide the right documents, like shipping papers, invoices, and proof of delivery. If you meet the terms, the bank must pay, even if your customer cannot. There are different types of LCs. The most common is the irrevocable letter of credit. This means the bank cannot cancel or change it without everyone's agreement. For even more safety, you can ask for a confirmed letter of credit. Here, your own bank promises to pay, even if the buyer's bank backs out. This is helpful if you don't fully trust the other bank, or if they are in another country. Letters of credit give strong protection and are trusted worldwide. They are best used for large deals or international deals, especially when you don't know the buyer well. The downside is that LCs can be expensive and involve lots of paperwork. If you make a mistake in the documents, the bank might refuse to pay. Overall, LCs are great for big deals, new partners, or risky countries, but may be too complex for small, everyday sales. Now that you know about trade guarantees, credit insurance, and letters of credit, which should you use? It depends on your trade deal. For small or regular deals with trusted buyers, a trade guarantee may be enough. For many customers or risky markets, credit insurance spreads risk and can help you grow safely. For big or overseas sales, especially with new buyers, a letter of credit gives maximum security. Sometimes businesses use more than one tool. For example, credit insurance plus a guarantee. Always read the fine print before you agree to any policy or guarantee. Ask about costs, what is covered, and how to claim if something goes wrong. Make sure the tool matches the size of your deal and the risk you're taking. Don't pay for more protection than you need, but don't take big risks without cover. Get advice from your bank, insurer, or a trade expert if you're not sure. To sum up, reducing credit risk is vital for every business that sells on credit. By using the right mix of guarantees, insurance, and letters of credit, you can protect your business and trade with confidence. Stay alert, keep learning, and your business will be safer and stronger.